Have you ever wondered about the best way to grow your money? Two popular options often come up: stocks and mutual funds. Both offer the potential for profits, but they work in different ways. Understanding these differences is crucial for making informed investment decisions. In this essay, we'll delve into the world of stocks and mutual funds, comparing their features, risks, and rewards to help you determine which investment avenue aligns best with your financial goals. Imagine owning a tiny piece of a giant corporation like Apple or Amazon. That's what it means to own stocks. When you buy a stock, you're purchasing a small ownership stake in a company, making you a shareholder. As a shareholder, you have the potential to earn profits in two ways: through dividends and capital appreciation. Dividends are a portion of a company's profits distributed to shareholders. Companies may pay dividends quarterly, semi-annually, or annually, providing investors with a regular income stream. Capital appreciation, on the other hand, occurs when the value of a stock increases over time. However, investing in stocks comes with risks. Stock prices can fluctuate significantly in the short term, influenced by factors such as company performance, economic conditions, and investor sentiment. If a company faces challenges or the overall market declines, the value of your stocks can decrease, leading to potential losses. Imagine a basket filled with different fruits, each representing a different company's stock or other investment. That's a simplified way to think about mutual funds. Instead of investing in individual stocks, mutual funds allow you to invest in a diversified portfolio of assets. When you invest in a mutual fund, your money is pooled with that of other investors. A professional fund manager then uses this pooled money to buy and sell securities based on the fund's investment objectives. This professional management is a significant advantage for investors who may not have the time or expertise to research and manage individual stocks. Mutual funds offer several benefits, including diversification, professional management, and affordability. They provide a convenient way for investors to access a wide range of assets, reducing the risk associated with investing in individual securities. However, it's important to note that mutual funds are not entirely risk-free. The value of a mutual fund's portfolio can fluctuate based on market conditions, and there's no guarantee of returns. Section 4. Risk and Reward. A tale of two investments. When it comes to investing, risk and reward go hand in hand. Generally, investments with higher potential returns also carry higher risks. Stocks offer potential for significant growth, but also substantial losses. Let's compare a single stock and a diversified mutual fund. A single stock might double in value within a year. Your investment could be worth $2,000. A diversified mutual fund might grow 8%. Your investment would be worth $1,080. The single stock yielded higher returns. Remember, past performance is not indicative of future results. Poor stock performance could lead to losses. A mutual fund offers moderate returns and a cushion against significant losses. Section 5. The power of diversification. Mutual funds spreading the risk. Imagine putting all your eggs in one basket. If you drop the basket, you risk breaking all your eggs. This analogy illustrates the concept of investment risk. Putting all your money into a single stock or asset class exposes you to significant losses if that investment performs poorly. Mutual funds mitigate this risk through diversification. By investing in a variety of assets, mutual funds spread the risk, reducing the impact of any single investment's poor performance on the overall portfolio. If one stock in a mutual fund's portfolio declines in value, other holdings may perform well, offsetting potential losses. Diversification is like having a safety net for your investments. It helps protect your portfolio from significant losses and promotes more stable returns over the long term. While diversification cannot eliminate risk entirely, it's a fundamental principle that can significantly reduce investment volatility. Section 6. Starting your investment journey. Which path to choose? For novice investors, mutual funds often present a more suitable starting point. Mutual funds offer a simplified approach to investing, providing instant diversification and professional management. They require less research and monitoring than individual stocks, making them less demanding for beginners. However, as your investment knowledge and experience grow, you might consider incorporating individual stocks into your portfolio. Investing in individual stocks requires thorough research, understanding of market dynamics, and careful monitoring. It's essential to remember that investing in stocks carries inherent risks. Before investing in individual stocks, it's crucial to conduct thorough research, understand the company's financials, and assess your risk tolerance. Section 7. Finding the right fit. Tailoring your investment strategy. Ultimately, the best investment choice depends on your individual financial situation, risk tolerance, and investment goals. Mutual funds offer diversification, professional management, and a lower barrier to entry, making them suitable for beginners and passive investors. Stocks, on the other hand, offer higher potential returns, but also carry higher risks, making them more appropriate for experienced investors with a higher risk appetite.